Thank you so much for coming.
Great to be here.
Always nice. So Jason, we'll start with you if that's okay. We have a lot of people in the audience, a lot of founders, enterprise startups. How many do you hear from every year? How many do you actually meet with? And then how many do you actually fund?
Emergence Capital is 100% focused on enterprise. We've been doing it for about 15 years. And we are in the golden age of enterprise right now. So when we started, maybe we saw a few hundred startups a year. We funded about 5 or 6. Today we see over 1,000 a year. We probably do deep diligence on 25.
Wow.
And same deal flow though, in terms of like the number of deals we actually end up investing in, because our focus is early stage and being an important partner to these companies. So
Right.
you can only invest in so many and do that well.
So tons of startups to choose from, obviously. Rebecca, you focus part of your efforts on enterprise. What are you looking for in a team exactly? What makes you kind of more comfortable with a founder? Is it certain certifications, industry expertise?
This is sort of hard. It's like, what do you look for in a husband, right? I mean, it's because you're essentially married. I mean, you're there. Sorry, you're there for 10 years, right? Exactly. So you are working for this person or with this person for 10 years, oftentimes, through good times and bad. And so you're looking for somebody who, of course, you're looking for a big market. So you're looking for a TAM that you believe a really big company can evolve and grow into. And then you're looking for some unique insight, especially in enterprise, that team had. Maybe they worked somewhere, they had a problem they were dealing with there, that they found a great way to solve it, right? And they had some unique insight. And I think especially on enterprise, that's critical to understand the market dynamics and the market forces. And then I don't know how to call it anything else but grit. Like I always talk to the founders, and I like their story. I want to hear about them, right? I want to hear about how they got there, right? And something about their personal life and their personal story that shows the grit that they have, because you have to have it. I mean, very few companies are, up and to the right their entire lives, and it's those times that that things don't go right that you have to pick yourself up and keep going and keep fighting, and that's what we look for.
Right. So many founders coming out of so many different industries, fintech, cybersecurity, real estate. Maha, how do you think about these different verticals? I mean, are you sort of shopping by vertical? Or are you sort of more interested in the founders who walk through the door?
So I'd say it's a mix of both. To your point, the golden age of enterprise is completely upon us, but it's transformed. So years ago, when we started enterprise investing decades ago, we were looking at more horizontal apps, and that could be CRM, it could be marketing automation, et cetera. And over the last, I'd say 10 years or so, we have at Canaan been really focused on franchise areas within enterprise, and that could be fintech, it could be insurance tech, where we have probably 5 investments in the last 2 years. Could be real estate tech, where we have equivalent activity. And it's morphing more and more from traditional infrastructure software, and again, these horizontal apps, to things that are much more verticalized and specialized.
Jason, what are you tired of seeing? What are you seeing too much of?
There's an increasing, the horizontal apps we've seen a lot of, but they're taking increasingly smaller slices of the problem and trying to pitch AI as basically a next generation solution for that. And to be honest with you, it feels more like a feature than a reason to start a company. So we like also these industry cloud, we call them industry cloud strategies, where you're really trying to build a company that can own 50% plus market share, be a leader in its category. So I think it's really tough to kind of pick off these little slices and build a significant company. Our business is all about building iconic companies, decacorns or $20 billion businesses, and it's rare that you can do that on a very thin slice. It's great to be focused to start, but you got to have a vision for how you can build a really significant business.
So obviously, right, you're looking for big markets, but you're also, as they're sort of maturing, you're looking for different metrics. Rebecca, if it's not too general a question, what sort of metrics are most important to you, and how are they sort of changing with subsequent funding rounds?
what metrics are important and how do they change? So I think in enterprise, probably one of the most important metrics is how much will your customer pay for this, and what is the sales force you have to have behind it. So we all hope for lightning in a bottle, where you build it and it's self-serve and you put it on your website and everyone comes and there's no sales force and you can sell it for $3,000, annually. Those things don't exist very often, right? And so what you look for in metrics are metrics that make sense for your business model. So if you have a fully staffed enterprise sales force that you need to really execute against your plan, you need an ACV that's between 50 and 100 grand, right, to really actually support that. And you need to be able to believe you can get there. And in addition to that, we look heavily, especially later stage, at upsells, right? Are you upselling? Are you cross-selling? Are you growing that? Is your net churn, is you have a negative net churn essentially? And so how do you get there? And so we really pay attention to that, because that shows us, with just the numbers, that you've built something the customers value, that they'll pay a lot for, and that you can sell into that. You can hire salespeople and continue to scale your sales organization to really go after it.
Maha, you invest in consumer and enterprise software. How do those metrics sort of change? I mean, you can sort of also upsell a consumer customer. What are you looking for?
There's a lot of overlap with respect to metrics. I'll tell you that as an early stage investor, I tend not to be so focused on metrics, as I'm sure these guys would say. And frankly, at the early stage in my industry, I feel like people are focusing almost too much on metrics and not as much, to Rebecca's point, on TAM. Ultimately, we make money, and this goes to Jason's point, investing in those decacorns, which frankly don't necessarily have that initial traction early. We're betting on huge, huge markets. But once the companies evolve, it is so much, there's so much of a correlation between consumer and enterprise, in that we want customers that love the product. We want customers that come back and come back and come back to us without us having to pay for them to come back. So the equivalent in a consumer company would be me having to spend advertising dollars to acquire that customer again, as opposed to that customer just coming back because he or she loves what I'm doing. So the same goes for the enterprise. I have customers that come to us because they love the service, they love the product, and they keep buying more and more and more. So there's a lot of similarities.
I have to say, I think we all probably rely on some enterprise products that we don't love, that for some reason just will not go away. I just wondered, when it comes to enterprise software, is salesmanship as important as selling the product? It sometimes seems like it is. Jason, what do you think?
I mean, nowadays, the beauty of enterprise is the product can sell itself. It almost sell itself. So great products are emerging today that are almost just being bought off the web. So Zoom's a good example of that, where it just spreads virally. You can build an enterprise team on top of it, but it's got that beautiful kind of nugget of self-service product. For the enterprise, we still find you need to have the go-to-market capabilities and support for those large accounts. That requires just a lot of resources and time and effort. So even a product like Zoom, which is a fantastic product, can be bought by an individual. I was at my school this morning, and they are using Zoom for parent-teacher conferences, right? And Walmart's a user of Zoom as well, with tens of thousands, hundreds of thousands of users. But you have to have the resources to support a Walmart, and you just can't buy it off the web. So I do think it's important to have that go-to-market expertise. At Emergence, we have several people from Box and Google and Salesforce, our platform team, that have expertise in building go-to-market teams. And that's been really effective in helping our companies scale. So.
You talk about Zoom. Slack is another one that sort of sold itself, so to speak. The employees started bringing it in, and then it sort of moved its way up to the upper echelons of companies. Is there sort of one way or the other that's better? Like, these days, is it better to go sort of bottom up or talk to CTOs? Rebecca,
yeah, I don't know if there's a better. I mean, there's no right way, right? We have a company, Viva Systems, that is the antithesis of viral and product-driven, right? They're an enterprise sales. Now, they were we raised $4 million, and they never raised another penny, and it's a $25 billion market cap company. So incredibly capital efficient and zero kind of product-led sales is all enterprise. And then you have the opposite extreme of a Slack or a Zoom, which is very much at the low end, kind of moving up. Also very capital efficient. So I think the key is being internally consistent in terms of your sales and marketing engine and muscle with the market opportunity. And then that fit, that right fit, there's product market fit and there's go-to-market fit, and I think you need both.
Which is tricky, though, to find. So, Rebecca, when you're talking to startups, you know, in some cases, growth trumps profitability, as you were talking about on email, Jason. How much is a reasonable amount of your revenue to be spending on growth?
This is a great question. I think it depends on your market timing. I've been through a couple cycles in the market right now, right? And there are all kinds of metrics out there that you can read about, right, in terms of different rules of SaaS and everything else. But, you know, I think it depends a lot on and those metrics sort of dive into whether or not, you know, what your churn rate is, if people are expanding, you know, if those customers are expanding in their annual spend with you, or if they're churning. But I always like to have a very clear eye on, if you know you couldn't continue to fund that growth, how fast could you get profitable and support yourself? So I think there's this sort of balance that companies should walk, that kind of keep an eye on that metric of what would be the path to profitability if we needed to hit it. Now, it looks like the markets are going to continue to do well, and everything is up and to the right. But you know, having lived through a couple of cycles where even though people had a lot of money and and weren't willing to let go of it, I think it's really it's prudent for the board and the founding team to look at what would happen and what if, and how, you know, if they needed to get profitable, what they could do, and then intelligently make those growth decisions based upon, you know, their customer metrics, and at the later stage, as you were pointing out, right?
I still think growth, as I point out, growth trumps profitability in the market today.
Yeah, so growth absolutely trumps.
You have to grow, and you have to be a market leader to generate.
And you have to grow significantly. 20% growth rate's not enough.
Doesn't
right?
cut it.
You need to be, you know, 40% plus, right? And that's a requirement in this market today.
I think is a requirement in all markets.
Yeah,
especially at the companies at the stage that we're investing. We need to have companies at that early stage or beyond that are growing 50, 60, 70%.
Right.
When they get bigger, of course, the growth rate slows. But once growth is abandoned, nobody wants to fund these companies.
No,
in any market. Right?
Yeah, but yes, growth, it has to keep going, absolutely, no matter what.
But capital efficiency is super important. Sales and marketing efficiency is the single largest cost for enterprise companies.
Absolutely.
So if you're spending $1 to generate $1 of recurring revenue, and you have churn, that's not such a great business. You know, companies like Zoom are spending a fraction of $1 and then selling more than $1 for follow-ons, you know, so the lifetime value relative to the acquisition cost of that customer is so much more valuable.
Absolutely. It's all about the lifetime value.
Plus capital efficiency is what builds.
Yes.
So that's ideal.
Yeah.
But there are many companies that have been that have done public offerings in the last couple of years that have had sales and marketing expenses that have exceeded revenue. And as long as they are growing at that 50, 60% level, or 40 even, the markets are giving them absolute credit for it. Will they eventually reach profitability? I have absolutely no idea. They say they will.
But the market
doesn't care.
The market
can turn like that, too.
That's right. That's right.
You have to be prepared for the opposite.
The fortunate or unfortunate thing is that you have 3 VCs here who have lived through ups and downs. So in many ways, at least I'm going to speak for you too, I'm sorry, but I find myself being sometimes the naysayer in the board meeting saying, gosh, you know what, always keep an eye on that profitability. If you have to get there.
Right. You want to know how to get there.
But on the other hand, what I think that can do, and we have to put that optimistic hat on, that sort of mindset can leave dollars on the table.
Yeah.
So again, we are in this business of making hay while the sun shines, and so we've got to push these companies to grow, and that oftentimes means spending more than you get in revenue.
So you're spending, but not everything's going to be Slack or Zoom. So sometimes these companies their growth slows, you have to turn to plan B.
Right.
I'm wondering, what are your conversations? Your jobs as VCs are also to talk to corporates, try to find like a home for your companies in that case. Are those conversations any different now than they were? Because the public markets are giving such rich valuations. I'm just wondering what acquirers are making of companies that are maybe not on that same trajectory.
The M&A market is really fascinating right now because there are a bunch of very, very large public companies that are acquiring they're acquiring not for necessarily strategic value for new product expansion, but they are acquiring because they need things to be big and accretive, right? So it's these $8 billion acquisitions. It's Salesforce buying Tableau. It's Microsoft buying LinkedIn. If they're going to acquire, they're either going to go really big or they're going to have tuck-in acquisitions of, let's say, $200 or $100 million or less. And those can be fine acquisitions, by the way. But if you notice, gone right now are the days of these $500 to $1 billion M&A outcomes. It's just not happening. It may, but I just feel like the large public companies are not interested. And they've told us that.
Our philosophy has always been you got to kind of assume you're going to have to build an independent company.
Yep.
Because you want to be bought, you don't want to be sold. It's really tough to sell a company. It's much easier to be bought. And the best alternative is to have an independent path. And it is challenging when companies start to slow their growth rate, and an IPO is not a possibility, and they've raised a lot of capital.
Sure.
Like that is it's a tough situation. And then it comes down to grit. It comes down
grit.
to, does the founder, want to slug it out and build a company and
Right.
going to do what it takes? I think Aaron Levy's a good example of that. Like it took a lot of capital to get to where he is, but it's a $700 million, revenue business and a great product and a great market opportunity. But it took grit to do that.
Takes a lot, and it takes a lot of really hard decisions. I mean, if you hit that point, I mean, the decisions to cut, right, and cut soon enough in terms of expenses to really try to reinvest then in growth. Those are hard decisions to make, but are options for entrepreneurs that have a lot of grit, right? To
Yeah.
sort of look and see where they can sort of rekindle that growth, and we've seen that with some really impressive
One of the
founders.
nice thing about SaaS businesses is the recurring revenue business, right? So in 2007, we took SuccessFactors public. In 2008, the financial crisis hit, and all of a sudden, profitability mattered a lot more. So
Right.
we reduced our growth rate and then started generating cash, right? And then when the markets came back again, we accelerated growth again. So at a certain scale, you have the opportunity to choose
Right.
growth
and levers,
versus
right?
profitability.
You can choose which one you want to push.
What is one of the most common mistakes that you see enterprise companies make? They could have all the grit in the world, but mistakes are made. What do they tend to be?
I see a lot of them.
There's one.
Hiring like a VP of
Yeah.
growth too quickly? Or?
Staffing up a massive enterprise sales force too
Yeah.
quickly. Like
Going
they get
too
some
fast
good, yeah,
up
They-
market.
Yeah, and they go too fast at market, and
Yeah.
they get some really great initial sales, and they think, oh, if I just had 10 more salespeople, right? And they don't quite have that go-to-market thing figured out quite yet, right? And then they end up spending a ton of money on sales too early before it's really sorted out.
I think growing your ACV, right, the amount that you can collect from every customer is a super important metric in the business. But if you're going from, let's say, a $10,000 or $20,000 ACV, and you're all of a sudden starting to sell $500,000 ACV, like something's probably wrong. Like you should really think about being a little bit more incremental in that growth. I've seen companies have false signals of success by a big customer coming and knocking on the door and realizing they didn't have the capabilities to actually service that customer. So my advice is always kind of try and double your ACV year over year, but don't 5X it.
The counterpoint to that is that we as venture people are wanting growth in these businesses. And I keep saying this word growth, but it really does matter. And when you're spending in a stepwise fashion, in a really methodical way, it can actually cause you to not have a large enough sales force to meet these growth numbers that you're anticipating for year 2 or year 3 or year 4. So it's actually really important that you invest ahead of that so that you can, collect the fruits of your labor. But there's this caution that we all have in not wanting to spend because we don't necessarily have a lot of those indications at that early stage. And that's the rub, right? It's a mistake, yes, but it's also a natural outcome of what we all are in this for. And so we just have to have our hands really delicately and deftly on the dial to be able to move things back and forth when we're seeing indications of growth or slowdown.
Going back even further, how do you help your startups, I guess, land that first big customer? How do you get that pilot project, turned into that first big sale?
I mean, we actually most of our investments have what I'd call very early product market fit, so a handful of customers that we can validate that there's minimum viable product there. So it's rare that we're investing in a company that's totally pre-product and zero customers. But like for the first significant enterprise deal, I remember sitting down with the ServiceMax folks when they were talking to GE. And it was like that was like the ultimate customer for ServiceMax. They sell field service applications, and we sat in the room and convinced them somehow, to bet on ServiceMax as a young company. And part of it was, we brought together folks from Salesforce and other successful SaaS businesses and really presented a vision for how we were going to build ServiceMax into this, mega company. Ultimately, GE became the acquirer of that company. They bought it for $1 billion 8 years later. So it was actually a really interesting story.
Very interesting.
Yeah.
Going back even further still, I wonder, again, consumer versus enterprise, is there a first mover advantage in any way for a SaaS company? I mean, we see so many companies out that sound exactly the same, but
Yeah.
I always wonder if there's,
So I have an opinion on this one, and I think it's a first mover disadvantage oftentimes.
Okay.
Having grown up at P&G, that was funny because even with them, they were like, let somebody else spend all the money on proving the market, talking to the consumer, making sure there's a need here, and then we'll just come in and kill them with like better technology and better sales, right? And so there are very few companies. I mean, look at Zoom, for example. I mean, Google Hangout should have owned that market, right? There are very few companies out there that are truly first mover. I mean, perhaps Amazon, right, with selling the books online and stuff. But other than that, if you name a company, you can pretty much name like 3 that came before it, right? And so I think there's a lot of talk about first mover advantage, and I always challenge people, and we can have this discussion about like, okay, tell me a true first mover. Because in hindsight, when you rewrite history, they look like first movers because you don't hear about the 5 that died before them, right? But oftentimes it's really smart to see a company that's really getting some traction, but not quite doing things right. And if people come in afterwards, the first company is going to have, tech debt that they have to overcome. They're going to spend a ton of money on just proving to the market that this is something that needs to happen. And if you come in on top of that with just a much cleaner, better solution, I think Zoom is a prime example, right? And a really great go-to-market, you can definitely win. So I'm personally not a huge first mover advantage kind of person. And also it creates this FOMO, right? Where people who are thinking they have this fear, this first mover, they spend money on a bunch of stuff out of fear, right? And oftentimes it's better just to sort of come in later.
I think some consumer businesses have this network effect, right, where the land grab kind of mentality does really pay off. Rarely is that true in the enterprise space. I only had one example, which was Yammer, which I felt like was kind of a new use case in some ways. And there was a network effect of the more people that use the product.
But then we have Slack, right?
Mm-hmm.
So
Slack came after,
right?
Right.
And so we have Facebook and we have, MySpace.
Yeah.
So.
Yeah, so it's harder. There's no question. The evangelical new use cases are riskier bets. Sometimes they pay off, though. So
Sometimes.
So Rebecca, we're almost out of time, but you sounded an optimistic note at the beginning. You said it seems like things are still going very well, but it does, to me, feel like there could be finally a recession around the corner. Who knows? I'm just wondering, are your conversations any different with your startups right now in terms of runway and how much they should have?
Yeah, I think going into the election next year, I think what the markets don't like is uncertainty, and no market likes that. And so I'm not. No matter how that comes out, I think things tend to freeze up beforehand a little bit. So, I think it's wise to tell people to, raise what they can now, and capital's flowing pretty freely. Right. So
we have a portfolio review coming up, and I think it's the first time in several years we've we've said, like, we want to do a stress test
Yeah.
on the portfolio.
Smart.
Like, how much cash is in the bank? What's the runway? What's the fundraising plans? Like literally every company in the portfolio. And you know, how are they managing expenses? I just think now is the time to be a little bit more thoughtful about it.
Are you going to do the rest in peace thing now for
No, I'm not going to do this Sequoia rest in peace.
The
thing,
tombstone.
so.
Guys, thank you so much for coming. It was great to see you. We really appreciate
Thanks,
it.
Connie.
Thank you, Connie.